Hello everyone, welcome to today's US Open live webinar. I am your host Nikos Zabouras, Senior Financial Editorial Writer at FXCM. It is Tuesday, September 26th, as the third quarter draws to a close, and it's our usual time, 10 minutes before Wall Street opens. US dollar strength persists this week in the aftermath of the Fed's hawkish hold, in contrast, of course, with the dovish stance of its major counterparts, who also announced their latest policy decisions over the past several days. This hawkishness also weighs on the Nasdaq, and on Wall Street in general, which looks for inspiration on Amazon's AI bet, as the AI hype has subsided over the past several weeks. That's pretty much what we will be talking about today, but as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully through the risk warnings and the disclaimers, and please bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. Let's give it a few more seconds and then we will get started. Okay, let's get the ball rolling. We're gonna start with Euro USD, which breaches critical tech levels after the ECB-Fed reversal, and then we're gonna move to USD JPY, which rises further after the Dovish Bank of Japan, and then we're gonna talk about Amazon's AI push that offers support to the Nasdaq, which is currently in a tough spot this month, actually, and the previous, given the Fed's hawkishness and the renewed risk for government shutdown in the US over spending bills. So let's go ahead with Euro USD. We already talked about the ECB and what it decided, and the Fed in previous sessions. In any case, the ECB this year has been tightening more aggressively compared to its US counterpart, but the favorable differential has been, for the Euro USD, has been eroding over the last couple of months, and the Euro's rate advantage unraveled after the latest decisions, as the ECB delivered a dovish hike and the Fed a hawkish hold. The pair, of course, reacted negatively to both decisions and now breaches the critical 38.2% Fibonacci of the 2022 low, to the 2023 high rise, and that exposes the pair to the 2023 lows at 1.0481. Although we are cautious at this stage for greater slump that could challenge 1.037. A look at the daily chart also offers some reason for concern, because as you can see, it is on the verge of the death cross, meaning that the 50 days exponential moving average is close to crossing below the 200 days exponential moving average. These are general precursors of strong moves. In this case, that would be for sustained weakness. The last time this had happened was around 2 years ago, as you can see on the left of the chart, and had eventually led to the last year's multi-year lows. However, this formation has not occurred yet. We do not know if it will, but if it does, it would add to this deteriorating outlook. On the other hand, the RSI on the daily chart points to overbought conditions, oversold conditions, sorry, and so does on the 4-hour chart. And the move looks a bit stretched, with the Euro-USD trying to find some reprieve. And although the ECB hinted at peak rates, it may have a hard time staying on the sidelines as inflation is still too high. As we said, Euro-USD tries to find some reprieve today and may get the chance to rebound. However, it does not inspire confidence for any meaningful rebound at this stage, because the upside is unfriendly, mostly with a strong confluence of resistances which looms in the 1.047, 1.049 region, roughly. So we're gonna be expecting later in the week, towards the end of the week, significant releases once again from both the US and Eurozone. So this could determine the next leg. Now let's move to the US dollar versus the Japanese yen. The pair set new 2023 highs after the Bank of Japan maintained its ultra-loose policy stance and outlook last Friday, with Governor Ueda doubling down over the weekend with dovish remarks. And of course, this came just a few days after the Fed had affirmed the higher for longer approach. This is what continues the favorable policy divergence remains intact at this stage, and this continues to fuel the pair's advance. As we said, new 2023 highs, and now eyes 150 round number, and then we have 152.2, which is a multi-decade high. But strong catalyst would be needed for that. We see again the RSI at overbought levels, so there is scope for a pullback, and of course there is scope for an FX intervention by Japanese authorities, which had last year, around this time last year, they had intervened at a far lower rate. Now, as I said, a pullback would be reasonable, but a strong catalyst would be needed for the EMA 200 to come into question, which is quite far at around 146.4. Now let's go to the Nasdaq, but let's talk about Amazon first. After its last quarterly results, I had written that Amazon's generative AI efforts appear to be in the background for now, as at this stage focus has been on the customer upfront, such as ChatGPT chatbot, which of course kickstarted this whole AI frenzy and this arms race for supremacy. Now this changes as the tech and retail giant announced a strategic partnership with Anthropic. Anthropic is an AI company that has a ChatGPT rival chatbot named Claude. Now, Amazon said it will invest up to $4 billion in Anthropic, while the AI firm will use Amazon's cloud to build, train, and deploy its large language model. So it looks like tries to enter the arena. Amazon tries to enter the arena where Microsoft, OpenAI, and of course Google are pushing forward. Generative AI has been the main driver of this year's tech rally, but the frenzy has moderated over recent months, and Amazon announcement can help reignite the excitement, especially as the new earnings season approaches. Amazon stock rose yesterday on the news and helped support the NAS 100, the tech-heavy index. Now, as we said, again, the Fed has stifled the AI blaze. We talked about how it delivered the hawkish outlook, this higher for longer credo, and that has been detrimental to the stock market. Now, National 100 goes towards the conclusion of a losing quarter and is at critical levels technically. You can see on the chart that it tests the 23.6% Fibonacci of its 2022 low, 2023 high rally. And a little below that, we have the August lows. A breach of this region would make it vulnerable to the 38.2% FIBO, and above that, the 200 days exponential moving averages. That's the 4,008, 30,842 area. On the other, and of course, let's not forget that we have renewed risk of a government shutdown as in the US, as Republicans and Democrats once again fight over spending bills. Now, we said that AI frenzy has subsided, and that's part of why we have this decline in the Nasdaq, but it's a transformational force that can continue to propel Wall Street forward. And of course, September is traditionally a bad month for Wall Street. The correction so far is limited, and the index has the ability to rebound. It will need catalyst, though, to surpass the 200 period EMA at around 15,170 and regain the initiative. Now, let's round off things with what's ahead. After last week's central bank bleeds, the current one starts in a subdued manner. Things do heat up over the following days, starting with durable goods, US durable goods on Wednesday, and then US Q2 GDP on Thursday before our next session. The US economy has generally performed better than expected, and that is one of the reasons why the Fed maintains its hawkish bias. So the GDP is going to be important. Of course, it's not the only measure, and perhaps not the best measure of the strength of the US economy. So that's it from me for today. We will talk again on Thursday at our usual time slot, 10 minutes before Wall Street opens. Thank you for joining me.